prices plunged by 20.6% on the Philippine Stock Exchange in the first half of the year as the investors are halted due to the pressing coronavirus pandemic. The average of trading value turnover in a daily basis was at 6.59 billion and was slimmer by 15.0% from the 7.84 billion recorded on the previous year. All sectorial indices were down in the first half, with all the sectors but service posting massive losses. In the light of this information, the Jollibee Food Corporation, as one of the leading fast food chain company in the Philippines, is also experiencing the same phenomena despite of its product or offered services being one of the basic needs of the masses, which is food. However, the Jollibee Food Corporation is mitigating their losses as the coronavirus pandemic has brought in the company through performing different activities and projects to be able to adjust and cope up in the new environment with resilience. Jollibee Food Corporation capital expenditure for this year was cut to 5.2 billion from 14 billion as a result of a bearish stock price. As the coronavirus pandemic continues to spread in the country, the stock price of JFC is also declining to the point that the market price per stock is 91.10 in March 19 from 211.60 in January 23, which is the highest value of a market price in the year 2020. Unquestionably, the reason of declining stock price is the declaration of enhanced community quarantine in the country, which resulted to a lower income or inflow of sales. In spite of this, JFC continues to perform projects to be able to expand internationally and generate more income. There are several press releases about the expansion of Jollibee Food Corporation in the United States. Last August 20, 2020, the new branch in Plano City, Texas, had a long line of cars as customer was curious about the new fast food restaurant. Another branch was earlier opened in Jersey City, in New Jersey, in July. The long-term goals of JFC are to have three strong pillars of growth, which is the Philippines, China, and USA. However, it does not mean that the Philippine business will slow down. The intention is to have its foreign business grow faster than its Philippine business. The crisis did not hinder Jollibee Food Corporation to donate 220 million pesos worth of food assistance amounting to 3.8 meals, more than 480,000 meals for hospital and health workers, 2.5 million meals for families in need, and 830,000 meals for checkpoint personnel. The CEO said that the employees of Jollibee was more resilient than ever in this time of crisis. It was their foundation even when their company was facing a difficult time in generating income.
Hi, I'm Danica. Before we dive into the ratios, let's first discuss about market value and its uses. So what is a market value? It is defined as the amount of which something can be sold on a given market. The market value ratios indicate the willingness of investors to value a firm in the marketplace relative to financial management values. This is according to Military and Norton 2017. And market value is also measured by its current share price to certain accounting values. It gives insights into how investors in the marketplace believe that the firm is doing in terms of risk and return. The market value ratios indicate the willingness of investors to value a firm in the marketplace relative to financial management values. This is according to Military and Norton 2017. Market value is also measured by its current share price to certain accounting values. It gives insights into how investors in the marketplace believe that the firm is doing in terms of risk and return.
Good afternoon. So for today, I will be discussing about earnings per share of the Jollibee Foods Corporation as well as its use and why is it beneficial to both a corporation and the investor's perspective. So, what is earnings per share? Earnings per share is usually used by a company to determine its profitability of issuing a stock to its investors. So, the higher the earnings per share of a corporation, it means that the company is really gaining a profit in the perspective of the investors. The higher the EPS, the more they will be attracted to a company, because they believe that if a high EPS would made them believe that a company has a appreciative value, as well as they also believe that they will be earning more than what they have invested. So for now, I will be discussing the formula for the earnings per share. So earnings per share is equals to the difference between the net income and the preferred dividends divided by common shares outstanding. So let's go and analyze the earnings per share of the Jollibee Foods Corporation for the years 2015 to 2019. So for 2015, there has a earnings per share of 4.61, which is good. For 2016, it increased to 5.73. For 2017, it increases to 6.55. For 2018, it has a incremental change of 7.66, and for 2019, it has a sudden decrease of 5.72. So the question here is, why is that the earnings per share for 2019 decreases? So the main reason for it is the incurrence of the expenses, such as the cost of goods sold, and which includes the depreciation and amortizations, as well as the interest expense, which is a bit big amount of difference from the previous years. So how can we resolve this? How can JFC improve its earnings per share for the year 2020 and for the succeeding years? Well, they need to improve their market and make sure that they will be increasing their sales, as well as to reduce their amount of expenses that they to be incurred in order to attain a high earnings per share for the 2020 and for the succeeding years. And for the other marketability ratios, it will be discussed further. Thank you.
I will be substituting for Norman Fernandez since he doesn't have strong internet connection enough to make him send a video. So at this point, we will be talking about the price to earnings ratio and its uses. First, let's define price to earnings or PE ratio. It is the relationship between a company's stock price and earnings per share or EPS, finding out whether they are overvalued or undervalued. Basically, in essence, the price to earning ratio indicates the peso amount an investor can expect to invest in a company in order to receive 1 peso of that company's earnings. So let's proceed to the formula of price to earnings ratio. So the formula for price to earnings ratio is price per share over or divided by earnings per share. Now, as you can see, JFC's price to earnings ratio from 2015 to 2019, results show that in 2016, JFC's price to earning ratio has decreased from 47.54 to 33.83, which means that investors were less willing to pay for JFC's stock at the end of 2016. JFC's PE ratio eventually stabilized around 38 during 2017 to 2018, and took a 2.37 decrease at a PE ratio of 37.23. It was likely that there was a change in price per share or earnings per share due to market-related factors or investors' sentiments affected by news announcements during the period. The decrease in 2019 is most likely associated with certain news announcements.
Moving on to book value per share. According to Adam Hayes, the book value per share is an indication of a firm's net asset value, which can be computed by subtracting the total assets by the total liabilities on a per share basis. It is commonly used by investors to find out whether or not a firm is indeed undervalued or overvalued. By comparing the book value to its market price, you can determine whether or not it is in fact overvalued or undervalued. If the book price exceeds or is greater than the market price, the firm is undervalued. If the book value is less than the market price, it is now overvalued. The book value per share can be computed by dividing the total common equity by the total common shares outstanding. The book value per share can be computed by dividing the total common equity by the total common shares
The next
outstanding.
ratio is the price to book ratio. It is also known as the PB ratio. It measures the market's valuation of the company relative to its book value. This is used by investors, particularly value investors, to identify potential investments. The market value of equity is usually higher than the book value of a company, which is why these ratios usually exceed 1.0. PB ratios under 1 are typically considered solid investments. This also means that investors are usually willing to pay more for the stock than the stock's accounting book value. Traditionally, any value under 1.0 is considered a good PB for value investors. It indicates that a stock can be potentially undervalued. However, value investors may often consider stocks with a PV value under 3.0 as their benchmark. The formula for the PB ratio is, as you can see, is equal to the market price per share divided by the book value per share. Now, before we go into the results of JFC's PB ratio, we need to understand first that a lower PB ratio might mean that the stock is undervalued, but it could also mean that something is fundamentally wrong with the company. Like with most ratios, this can vary by industry, which is why it is important to compare JFC's PB ratio with the industry's average. The PB ratio can also indicate whether or not an investor is paying too much for what would remain if the company immediately went bankrupt. It would show an investor how much he is willing to pay for the company's book value of equity. This is because the book value is what would remain should a company liquidate its assets and pay off all its debts. Now, going to the results, we can see that in 2015, JFC's PB ratio was at 7.66, which then experienced increases and decreases up until in 2019, when there was a sharp decrease around 4.73. Now, the PB ratio fluctuated around 6.2 to 6.5, kind of showing stability during 2015 to 2016. From 2017 to 2018. Now, searching for the possible reasons of why this trend can be observed, it is quite possible that investor sentiment and other market-related factors has caused the market price per share to fluctuate from 2016 to 2018. The decrease from 2019 also shows that significant news announcements most likely have occurred. An example of this is according to Austria 2016, Business Inquirer.net 2019, and Lopez 2019, all makes mentions of JFC's efforts to expand, specifically in 2016, where it planned to expand 200 stores, while in 2019, JFC participated in merger and acquisition activities. Therefore, it saw that most of its profits were lowered down, therefore also affecting the price to book ratio.
Hello everyone, I am J. Mark Klein Langido, and for this section, I will be discussing the last ratio from the market value ratios, which is the price to cash flow ratio. And we will be applying it to the data of Jollibee Foods Corporation from 2015 to 2019. So what is price to cash flow ratio? So this ratio uses operating cash flow which adds back non-cash expenses such as depreciation and amortization to net income. It is a stock valuation indicator or multiple that measures the value of a stock price relative to its cash flow per share. It evaluates the company's stock price relative to how much cash flow the firm is generating. It is useful for valuing stocks that have positive cash flow but are not profitable due to large non-cash charges. The price to cash flow ratio is said to be a better investment valuation indicator than the price to earnings ratio due to the fact that cash flows cannot be manipulated as easily as earnings, which are affected by depreciation and other non-cash items. It shows the peso amount investors will pay for 1 peso of cash flow. To find the optimal level of this ratio, it depends on the sector in which a company operates and its stage of maturity. For example, a new and rapidly growing technology company may trade at a much higher ratio than a utility company that has been in business for decades. This is because, although the technology company may only be marginally profitable, investors will be willing to give it a higher valuation because of its growth prospects. The utility, on the other hand, has stable cash flows but few growth prospects, and, as a result, trades at a lower valuation. Although there is no single figure that points to an optimal price to cash flow ratio, a ratio in the low single digits may indicate the stock is undervalued, while a higher ratio may suggest potential overvaluation. Next is the formula. So to compute the price to cash flow ratio, we have the price per share or the year-end annual stock price divided to cash flow per share. So to also get the cash flow per share, we need the net income from the income statement plus the depreciation and amortization from the cash flow statement divided by the common shares outstanding. Now we have the JFC's price to cash flow ratios from 2015 to 2019. So based from the 2019 result, the company's investors are willing to pay 13.72 pesos for every peso of cash flow. If we look on the annual data from 2015 up to the recent one, you can see that the results are slightly unstable as reflected from the fluctuating year-end stock prices despite of an increasing cash flows per share over the years. However, it also reflected a decreasing trend on the values as it reached 2019 if we look at closer, which means that the cash flows received by the company is on a decline. And that is what I had said in the written report or the notes. But to correct that, it may also mean that a low multiple indicates that a stock is undervalued. Again, although there is no consensus regarding the optimal levels for the price to cash flow ratio, it is commonly accepted that a low multiple indicates that a stock is undervalued. On the other hand, the high price to cash flow ratios are common for companies in their early stages of development when the stock price is mostly valued based on their future growth prospects while a small amount of cash is generated.
Jollibee Food Corporation's market value ratios were showing stability. There was a significant overall decrease in years 2015 to 2019 to most of its market value ratios when comparing them. The earnings per share declined, which means that they are making lesser money for each share of its stocks. Similarly, the price to earnings ratio also decreased, which indicates that the investor's willingness to pay to the company's stocks has also declined. The same case also happened to the price to book ratio and price to cash flow ratio. Nevertheless, the book per share value of the company has increased since there was an increase in common equity and shares outstanding. For example, the decrease of price to cash flow ratio as well as most of their other market value ratios was due to JFC's continuous expansion and M&A activities in year 2019. Other news announcements during 2016, such as JFC's 200-store expansion, most likely affected and decreased its market value, but it doesn't necessarily mean or imply that the company is not growing. For our recommendations, first, in order to increase the earnings per share and price to earnings ratio, they must increase their net income or expand their margin by lowering costs, therefore eventually increasing their earnings and positively impacting the market stock price. Second, to be more careful on their investment decisions in the future, they must strengthen their market research or feasibility studies and practice frugality as much as possible as the pandemic is still ongoing.